Fox Business Alert, another weight has dropped on the back of private credit. Barings Private Credit Fund is the latest to cap or gate withdrawals of investor money at 5% after investor redemption requests soared to 11.3% in the first quarter. Barings now joins Apollo, Blackstone, Ares, and Blue Owl, a business development company at the center of much of the latest redemption upheaval, all putting up gates as redemption pressures build. Private credit may be at an inflection point, from liquidity concerns to valuation questions. Investors have been very nervous because the biggest redemption catalyst stems from the SaaS-pocalypse, SaaS as in software as a service apocalypse, which refers to the fear rippling through the market sparked by Anthropic's Claude, raising questions about how fast AI and Claude models could disrupt software, which is the very sector that private credit lends heavily to. So is this exodus isolated to private credit? Can it be turned around? Joining me now, Steve Pagliuca, former Bain Capital co-chair, now senior advisor to Bain Capital's private equity team. Bain's private credit arm, for those of you who don't know, has $58 billion in assets under management. And Steve, of course, is also the CEO of PagsGroup family office. Good to see you, Steve. How are you?
Great to be here.
Okay, so you are very familiar with private credit over many decades, although it has become sort of a new thing for retail investors. And when they started to see that names like Anthropic's Claude were coming out with new models that could actually really disrupt or maybe render obsolete some software subscriptions, people got very nervous. They wanted their money out. They didn't read the fine print that said you can only redeem 5% per quarter. So tell me, are you worried because these redemption requests are piling up and adding a lot of pressure to the stocks of private credit companies and to the private credit leaders?
I'm not that concerned. The bottom line is I think we're seeing an overreaction here. Private credit is now a $1.5 trillion to $2 trillion business. And I talk to these firms all the time, not only our own Bain Capital, but Ares, Apollo, Blue Owl. And those gates are misunderstood. The gates are really more like a safety belt. When people sign up for private credit, because you get yields way in excess of treasury bills, the private credit companies are returning somewhere between 8 to 10% unlevered, which is almost twice T-bills, and low teens if they lever those BDCs. But they are good companies. They're well diversified, and in today's world, in doing private equity deals, LBO deals, they're not as leveraged as they used to be. So there's a lot of protection of equity, maybe 40, 50% equity underneath those loans. So I think there's been an overreaction. Claude we're in the early innings of AI. Claude is going to change things. It's not going to happen as quickly as people think. Software as a service is still going to be around. There are certain segments that are really exposed. But again, I think Bain Capital's portfolio has less than 10% software service private equity loans in it, and many of the others are the same. And we have not seen, people are confusing redeeming out of the funds to credit losses. We've not seen huge credit losses. Their books are audited by reputable auditors. So again, I think there's been an overreaction. And part of that is the market's now accessible to retail investors. And retail investors have not, as you said, read that fine print, that this is more of an illiquid asset. And the gates are actually there to protect them, because if people want to bail out, they have to sell these credits at low prices. That the 5% withdrawal limit prevents that. And that's clearly in the documents. I think we have to publicize that more. I do think it's actually a great asset class now, and it's a great asset class for retail investors. And I'd probably be buying rather than selling.
Oh, you'd rather be buying than selling. But can I just push you on that point that you just made? So you agree that some of the onus is on private credit funds to make it much clearer to the perhaps less experienced retail investor who is newer to this space, make it better and clearer, the disclosure about, hey, you don't just cash out all of your shares. We only allow 5% each quarter.
Basically, any new market is going to have some hiccups, and the benefit to retail investors is large if you can get double T-bill rates and not take enormous amounts of risk, and that's what private credit does. But I do think, as in any new market, it's got to be made really clear for brokers selling that this is a less liquid asset, and there will be periods where you can't get out because you don't want to really destroy the entire market. So that's why those gates are there. It's very clear that it's there, but I think it needs to be publicized more for sure.
So we're looking at some of the managers with private credit, and Blackstone is in there. Blackstone does a lot of private equity, just like Bain does, Ares Management. But if you look at the year-to-date pictures of some of these stocks, it is not a pretty picture because of the nervousness. Blue Owl, I believe, has lost about 43% year to date. Ares down 36% because there is this nervousness. You and I were talking on the phone. You called it retail hysteria. But here's the thing about nervousness. When it begins to pile onto itself, doesn't matter if there's any there. Its perception is reality, and the herd starts stampeding. The big concern on behalf of now Treasury, the Treasury Department has said it is going to have a meeting about this, and the Federal Reserve, the big concern there is that this could become a little bit of a spillover into maybe the big bank picture, although, for example, John Williams, last week in a Fox Business exclusive, told us this about the systemic risk. Listen, I'll let you respond.
The question, though, I'm very focused on, and we're studying carefully, is how exposed are the banks? Because the banks lend to the private credit, their entities, and making sure that that doesn't somehow become more of a greater risk. But right now, I don't see it as the systemic risk to our system right now, but something really watching carefully.
He did kind of hint, Steve, that he felt there should be a repricing or reassessment of the valuation of the underlying loans that the private credit guys have made to some of these companies, be it mid-market software companies or anything else.
I tend to agree with him, but I believe the banks are in really great shape. They're well managed. Brian Moynihan and Jamie Dimon are lenders into this market. They have very strict underwriting standards. And you got to step back and say, private equity and private credit is really equity. So you're not taking systemic risk. Banks are well capitalized. Now, banks, when a bank goes down, it causes many loans to be withdrawn, and there's a multiplier effect. You don't have that with private credit. It's mainly institutional equity investors or retail equity investors, and they lose their equity, but there's not a multiplying effect. And I think, John, they're right about the banks. The banks are in pretty good shape right now. The last round of regulation, in fact, they've been well managed by those folks for a number of years now. They're very solid. I just talked to a couple of them today, and they're feeling very good about their balance sheets. So I don't think we're going to see a quote spillover because there isn't a systemic effect on what is an equity-like instrument.
So they're telling you they feel comfortable, and that's not just whistling past the graveyard.
Absolutely, absolutely not. They're well capitalized. Okay. They're diversified. The bigger issue is probably macroeconomic issues, obviously with the war in Iran, oil prices, and a $38 trillion deficit. Those are the things that are going to cause the economy harm. I don't think it's going to be private credit.
Okay, I want our viewers to watch Steve's eyes because they're about to light up when I bring up soccer and the World Cup, okay? We all know that the World Cup's coming to the U.S. this summer. Our sister network, Fox Sports, is going to be carrying so much of it. It's going to be a huge deal. And, you know, you, as a former major owner of the Celtics, I think you still have a private part of it, but let's talk about your soccer team, the Italian Series A soccer club, Atalanta BC in Italy. Ultimately, they failed to qualify for the World Cup, but how do you feel about players from your team trying to qualify for other countries? You got some players on your team who will be playing in the World Cup, right?
Yeah, absolutely. Kolasinac and Pasalic playing for Croatia and Bosnia, respectively. We've got Kettler on the Belgian team. So we were well represented. It was a real pity that Italy is not in the World Cup because it's been a soccer power for many years. Yeah. And I'm going to Italy for this weekend for a big game, and I'm sure they've been in a depression in Italy for the last 4 or 5 days with all the reports coming out, and they've fired the director of the Italian Soccer Federation. Soccer is they call it football there. Soccer is just really part of the culture. So I think there'll be a Manhattan-like project to fix the system, to make sure younger players are playing. There's all sorts of recommendations right now, but it is a shock to the Italian people because they've won the World Cup in the past and they've been a fantastic squad, but it didn't happen this time.
Good to see you, Steve, and thank you very much for joining us.
Great to be here.